The US30, the Dow Jones, came under a lot of pressure recently in the wake of the latest Fed meeting. The US Central Bank signaled it could hike interest rates twice in the year 2023, and this caught traders by surprise because it was in stark contrast to the updated March, which didn't signal any rate hikes for the year 2023. This could be the beginning of the US Central Bank laying the foundations for the idea that monetary policy is going to tighten in the next 18 to 24 months. And although that's some time away yet, it could influence other central banks around the world to maybe also considering altering the language around their current monetary policy. Now, even though the US30 came under pressure post the Fed's update, it's worth remembering the US30, the Dow Jones, was already seemed to be turning over on itself in advance of the meeting. So the update really put additional pressure on the US index. It did manage to fall back to a level last seen in May, and keep in mind the recent lows is 33,621, which we are comfortably above, but while we hold below these three metrics here, these three simple moving averages, it's likely the near-term negative trend is going to continue. A move lower from here could see it retest this zone here, and a break below 33,621 could see a target at 33,472. If you take a look at the near-term price action of the US30, we can see that it's comfortably off its recent lows, and it has managed to trend within a fairly small range recently. It is possible that if we hold above the recent lows, we could look to form a bit of a base here, and if we move higher from this area, we could look to retarget 34,087, and a break above that could see a target 34,197. Now, I mentioned about how the US30 was already in decline before the Fed meeting, and that accelerated the negative move. This was in stark contrast to the UT100, the Nasdaq 100. The UT100 hit a record high shortly before the Fed meeting, although the tech-focused index came under pressure in the wake of the Fed meeting. It has quickly shaken off the short-term negative trend, and we're now back at all-time highs on the Nasdaq 100. Although we have retreated a little, the broader upward trend is still very much intact. While we hold above these three simple moving averages, it's likely the broader bullish trend is going to continue. A move higher from here could see a target 14,300. Any pullbacks in the Dow Jones, in the UT100 rather, could see a target 14,022. Now we've talked about how stock markets have reacted to the Fed news. Let's take a look at some of the currency markets, starting off with the pound versus the US dollar. Pound dollar came under a fair bit of pressure in the wake of the Fed update. This is because there's been a broader increase in the US dollar. It is worth noting pound dollar was ever so slightly drifting lower in advance of the meeting, and we have seen further pressure since. In fact, in the last few hours, we've seen pound dollar fall back to its lowest level since May. So we're talking multi-month lows being achieved on pound dollar. If we continue to kind of move on lower from here, we could look at heading back down towards 1.3838, and a break below that could take us down toward this zone in around 1.38. It is worth noticing there's a relatively long wick on this candle here, which could be a sign of indecision. Should that be the case, and if you can hold above the recent lows, we could look to retest 1.3443, and a break above that could see a target 1.4008. Now, pound dollar is likely to be in focus this week because the Bank of England have their interest rate decision meeting on Thursday. Now, economists are expecting monetary policy to remain on hold, but keep in mind the Fed have already signaled about potentially hiking rates in the next 18 to 24 months. At the most recent Bank of England meeting, the central bank voted to keep its stimulus package unchanged, but one member of the 9 voted to reduce the stimulus package. Now that inflation in the UK is at 2.1%. We've seen a multi-year high in inflation. We've heard from the Federal Reserve about potentially hiking rates in the next couple of years. We might see more members of the Bank of England vote in favour of reducing the stimulus package. Should that be the case, we could see a rebound in the pound across the board. Also, in terms of the currency markets, we have seen a negative move in euro-dollar in the wake of the Fed's update. This is also going to be important in the context of the flash PMI manufacturing and services reports, which are due out this Wednesday. The manufacturing and service reports will cover France and Germany, the two largest economies in the Eurozone. Traders are going to be wondering, are we seeing a continuation in the rebound in the two largest economies in the Eurozone, or are we seeing signs that things are going to actually taper off a bit? So this is likely to have a fairly significant impact on the euro. As you can see here, the euro was already seemed cooling ever so slightly, and it seemed to be drifting before we had the aggressive move to the downside in the wake of the Fed update. Similar scenario here. We've seen euro dollar fall to a multi-month low, multi-week low in the past few hours. We're down at levels last seen. The euro dollar recently fell to its lowest level since early April rather. So we're talking multi-year lows, multi-month lows we're seeing in euro dollar in the last 2 hours. If the broader negative trend continues and we take out the recent lows here, down around 1 spot 1884, we could then look to head back down towards 1 spot 1867. And then if you go below that, we could then be heading down toward this zone here, down around, well, just south of 1 spot 18 in at 1 spot 1795. If we do manage to hold above the recent lows, and if we do manage to rebound from here, we could then be looking at retesting the 1 spot 2005 area.